$500,000 in tech equity compensation, 4-year vesting schedule, expected payout in 2027. Then you read a filing that changes everything. One founder controls voting despite a $157 billion valuation and institutional investors on the board. That's not the main story you'll hear, but it's the story that determines when you actually see your money. Uber had the same structure in 2016. Airbnb too. The voting fights that followed trapped employees in extended lockups for 3 to 5 years beyond original timelines. At $600,000 equity value, that delay costs you roughly $120,000 in foregone compounding alone, not counting unplanned tax liability when exit timing shifts. By the end of this video, you'll know exactly how to read the filings that signal this risk, what happened to the last 3 unicorns that faced governance disputes, and the 3 questions every equity holding tech worker should ask before signing. Here's the filing detail most people miss. OpenAI's recent $157 billion Series D included major institutional investors, Thrive Capital, Khosla Ventures, Microsoft. Standard assumption: voting structure is balanced. Board has checks. Exit timeline is protected. The actual Delaware corporate documents and investor disclosure filings show otherwise. Per multiple disclosures analyzed by legal tech platforms and investor relations databases, Sam Altman retains de facto voting control through a combination of founder share classes and board seat concentration. This isn't speculation. It's in the corporate structure filing. Compare this to Uber's S-1 prospectus filed in 2019. Travis Kalanick originally held similar control. The resulting proxy battles and shareholder disputes between 2017 and 2019 delayed the IPO, extended employee equity lockups by 24 to 60 months beyond original vesting schedules, and cost early-stage employees $100,000 to $400,000 plus in timing risk. The fight wasn't about valuation. It was about voting rights, board composition, and founder exit optionality. Airbnb faced nearly identical governance disputes. Their S-1 voting restructuring, visible in the prospectus's governance amendment section, took 18 months to resolve. Employee equity that was supposed to become liquid in 2020 remained illiquid until 2021 or 2022. Here's where concentration risk hits your wallet. Imagine you accepted $600,000 in OpenAI secondary shares at the Series D valuation. Your equity agreement says 4-year vesting. You plan to liquidate in 2027. Now a governance dispute emerges. Investors push back on voting structure exactly like they did with Uber. Founder negotiates. Board deadlock. Legal fights. The IPO or secondary liquidity window closes. Timeline extends by 2 to 4 years. Your $600,000 doesn't grow. It sits. At 6% annual opportunity cost, that's $76,000 foregone in year 5, $120,000 plus by year 7. That's your house down payment delayed. Your Roth conversion window missed. Your tax bracket creep because you liquidate in a higher income year. IRS publication 3921 specifies QSBS, qualified small business stock, holding periods. Early exit due to liquidity events can trigger unfavorable long-term capital gains treatment if timing misaligns with the 1-year holding requirement. Uber employees who accepted equity in 2012 expected payoff in 2016. The voting restructuring extended realization to 2019 or later. The cost per $500,000 position, roughly $80,000 to $150,000 in compounding, tax bracket alignment, and life planning misalignment. 3 things to check before accepting equity. 1. Request the corporate voting structure. If founder holds 50% of voting rights despite 20% of economic ownership, concentration risk is real. 2. Ask about board composition. How many independent directors? Does the founder have veto rights on exit decisions or IPO timing? 3. Research the company's last funding round filing. Look for investor class disputes or governance amendments. If recent amendments were required, that's a signal the structure was contested. OpenAI's next funding round documents, when filed, will reveal whether institutional investors demanded voting restructuring like they did at Uber and Airbnb. That timeline matters to you today. Same facts institutional investors see. Different reading. If you hold private tech equity or are offered it, your exit date depends on founder control as much as valuation. Subscribe. Next video covers how to read 13F filings to spot which venture firms are abandoning concentrated founder positions. Ring the bell. What's your biggest concentration risk right now? Equity at one company, one voting structure, one founder. Drop it below.